If you have a couple $100,000 and a passion for fitness, opening a gym seems like the ultimate cash flow machine. You rent a warehouse, buy a fleet of barbells and treadmills, and charge 500 people $50 a month. Once the equipment is paid off, those monthly subscriptions keep rolling in automatically while your front desk staff sweeps the floor. It sounds like a predictable asset-light subscription business wrapped in a physical building. The reality is that traditional fitness centers are among the most financially fragile brick-and-mortar operations in commercial real estate. What looks like a real estate play selling health is actually a precise mathematical bet on human failure. Specifically, the guarantee that the vast majority of your paying customers will never walk through the door. To understand why, you have to look at the physical limitations of space. A standard 10,000 square foot gym can comfortably host about 100 people at a time during peak hours, usually between 5 and 8 in the evening. If every single person who bought a membership actually showed up to use it, the building would breach local fire codes within 24 hours, the parking lot would collapse into gridlock, and the line for the bench press would stretch out the front door. To survive financially, a gym cannot function like an ordinary business where sales match consumption. It has to sell space. It does not have to people who will not use it. This model is built on the oversubscription ratio. While a boutique studio might cap its member base at 3 or 4 people per square foot, a budget gym chain systematically sells between 10 and 20 times its actual physical capacity. They are not selling access to exercise equipment. They are selling the psychological comfort of having access to exercise equipment. The moment a member builds a consistent, disciplined routine, they become economically inefficient for the owner. A dedicated athlete who works out 5 days a week consumes wear and tear on machines, burns through air conditioning, uses hot water in the showers, and takes up floor space that could otherwise belong to 3 passive account holders. This dynamic creates a bizarre structural inversion. The ideal customer for a gym's balance sheet is a person who pays $10 to $20 a month, sets up automatic credit card billing, and stays home. Getting people to buy a membership and never use it is exceptionally difficult to sustain over time. The fundamental weakness of this business model is churn, the percentage of members who cancel their subscriptions every month. The fitness industry suffers from some of the highest turnover rates in subscription economics, averaging between 30 and 50% annually. That means half of a gym's total customer base vanishes every 12 months. To keep the lights on, an owner must constantly replace those departing members just to stay at break-even. This turns the operation into an aggressive marketing engine disguised as a health club. The cost to acquire a new customer climbs higher every year as digital ad rates rise, eating away at the slim profit margins generated by basic membership dues. When you break down the financial ledger of an independent gym owner, the numbers reveal how razor-thin the margin for error really is. Commercial real estate leases represent the largest non-negotiable expense. A 10,000 square foot footprint in a mid-sized suburban strip mall can easily run $15 to $30 per square foot annually in base rent, plus common area maintenance fees, taxes, and insurance. Before paying a single employee or turning on the lights, the facility accumulates $15,000 to $25,000 in monthly space overhead. Then comes the capital equipment expense. Commercial-grade treadmills cost upwards of $7,000 each and have a functional lifespan of roughly 3 to 5 years under heavy daily use. Free weights, cable machines, rubber flooring, and turf tracks require significant upfront capital, often financed through high-interest equipment leases that add another 4-figure line item to the monthly liability column. Add utility bills that spike during summer cooling months. Commercial liability insurance policies required to cover injuries, specialized facility management software fees, and payroll for trainers and maintenance staff. A gym with $30,000 in monthly top-line revenue can easily see $27,000 swallowed by fixed operations. This leaves the owner vulnerable to minor operational shifts. A sudden 2-degree increase in regional utility costs or a 5% drop in quarterly renewals can instantly push a profitable month into a loss. Because basic membership fees rarely yield substantial net margins after covering fixed overhead, successful gym owners rely on secondary monetization strategies. They transform their floor space into a multi-tiered sales venue. Personal training is the primary profit engine here. While a $20 monthly membership barely covers the cost of maintaining the locker room, A $60 an hour personal training session yields a high gross margin, even after paying the coach their commission. High-performing facilities design their sales floors to funnel new members directly from the sign-up desk into an introductory assessment, aiming to convert 10 to 15% of the passive base into high-margin coaching clients. Beyond training, owners leverage retail fridges stocked with high-margin energy drinks, branded apparel, smoothie bars, and premium access tiers like hydro-massage chairs, tanning beds, and recovery boots. The basic membership gets the customer through the door, but upsells keep the business solvent. When this carefully balanced machine encounters friction, the decline happens rapidly through a predictable economic chain reaction. It usually begins with a sudden push for growth. To boost revenue, an owner runs a promotional campaign offering zero sign-up fees and discounted rates. This creates a temporary influx of hundreds of new active members. Because the facility's physical footprint has not expanded, the peak hour capacity breaks down immediately. Long wait times for equipment frustrate long-term, high-value members who pay for personal training. The environment deteriorates, cleanliness declines, and those core, profitable customers cancel their accounts. To replace the lost revenue, the gym is forced to lower its prices further to attract lower-tier consumers, degrading the brand positioning and eroding gross margins. As cash flow tightens, the owner defers routine maintenance on equipment. A broken cable machine stays out of order for weeks. A worn treadmill belt is left unreplaced. Visible decay drives away another wave of members, dropping revenue below fixed rent obligations. At that stage, the fixed lease debt consumes whatever working capital remains, pushing the business into insolvency. This exact failure chain reaction played out at scale with Town Sports International, the parent company of New York sports clubs. Founded in 1973, Town Sports grew into a dominant mid-tier regional powerhouse with over 150 locations, building a massive footprint across dense metropolitan markets. For decades, they relied on a traditional mid-tier model, charging members roughly $40 to $70 per month for broad access to clean facilities, pool amenities, and weight rooms. However, as the commercial real estate market heated up and consumer preferences shifted in the 2010s, Town Sports found itself trapped in a toxic economic sandwich. From below, low-cost options like Planet Fitness disrupted the market by offering $10 monthly memberships backed by massive national marketing budgets and stripped-down facilities that eliminated expensive amenities like pools and saunas. From above, premium boutique studios like SoulCycle and Barry's Bootcamp began capturing high-income consumers willing to pay $35 per single class for an elite, hyper-focused group experience. Town Sports was caught in the middle. Too expensive to compete on price with the budget chains, but too generic to compete on experience with the boutiques. To maintain market share, Town Sports slashed membership prices across many of its flagship locations down to $19 a month. But they did so while still saddled with massive, high-rent urban real estate leases and heavy debt obligations from previous expansions. The math failed completely. The drastic price cuts failed to generate enough volume to offset the drop in average revenue per user. The company began deferring maintenance, member complaints skyrocketed, and customer churn accelerated. When unexpected market shocks hit in 2020, Town Sports had zero financial cushion left. Burdened with hundreds of millions of dollars in lease liabilities and debt, the company declared Chapter 11 bankruptcy, liquidating assets and wiping out shareholders. The downfall of mid-tier operators like Town Sports forced a dramatic restructuring of the entire industry. The middle market collapsed, leaving behind a starkly bifurcated landscape. To survive today, a gym must operate at one of two extreme ends of the economic spectrum. On one end is the hyper-scalable, low-cost volume play. Operators in this space cut variable costs to near zero, eliminate high-maintenance equipment, mandate automated sign-ups, and rely on massive scale to turn a profit on $10 to $20 dues. They accept that 80% of their members will never attend, using that low price point specifically because it falls below the threshold where consumers actively bother to cancel an unused subscription. On the opposite end is the high-margin, high-touch luxury model, exemplified by brands like Equinox or specialized CrossFit boxes. These facilities charge anywhere from $200 to $300 per month, or $30 a class. They explicitly do not rely on ghost members who stay home. Instead, they cap membership numbers, invest heavily in premium amenities and labor, and deliver an elevated status ecosystem where active utilization is the entire point. If you try to operate anywhere between those two poles, the cost of space and equipment will quietly destroy your business. Looking at the industry through this financial lens reveals what owning a gym is actually about. It is not fundamentally an exercise in promoting physical health, nor is it a simple service business. It is a high-leverage exercise in physical asset utilization, commercial lease management, and behavioral probability. An owner is trading long-term fixed debt against the wildly unpredictable habits of the human mind. The workout equipment on the floor is merely the visual artifact that justifies the subscription fee. The real financial balance sheet rests entirely on the choices of the people who buy a membership in January and stop showing up by February.